we have Sopnendu Mohanty, the Chief Technology Officer of MAS, with us. And because of the time zone difference, we would have you in the morning. So that was the other reason why we have it now. And with that, I think I might kind of pass over to you. The other speaker we have is Michael Cole-Fontayn. People who've joined our conference in the past will know that Mike has been a loyal participant. As the chairman of AFME, the banking association, the Wholesale Market Banking Association, and also importantly for this session, in his role as a board member of the GFMA, the Global Association, because it's important to bring the global perspective to this. But with that, maybe Sopnendu, I pass over to you, because Singapore has been really at the forefront, and you've had an amazing conference quite recently on linking technology and fintech, importantly, to solving some of these sustainable finance challenges that we have and that we discussed the last few days. How are you dealing with this? How are you looking at this in Singapore?
First of all, good morning, I guess, for having me into this discussion. Yes, you're right. In fact, I would say our focus on connecting finance and fintech and extending to green started 2 years back. But I'll say a funny thing that in two years back when it started, and we used to run green fintech, and when we had a large hall of 1,000 people, only 10 people used to sit in that hall, watch people talking about green fintech. It was not an attractive topic, despite the big awareness in this space. But last year, during pandemic, we had this last December, we had this event. Things have changed. I think the level of awareness among people to think about green fintech has dramatically changed, and the response we got was tremendous. But let me give you a macro picture of where we intend to, and what is green fintech? In fact, that's a big question. We have broken the green fintech into three buckets, and we call it Project Greenprint for sake of running this program over multiple phases in the next couple of years. So essentially, there are three areas to focus on. First is, how do we mobilize capital which can be addressed to solutions which are going to solve the green issues? Because we're also hearing from market that a lot of the innovation in the space of green are not attracting enough capital, and there are a lot of need for early stage funding. So the idea is, from a green fintech perspective, is to build and think about a marketplace where green solutions can be bought into a public platform, and that can be used to raise capital, because that is critical. Because for any innovation to succeed, you need to have a lot of risk capital to go behind this innovation, which is providing the opportunity to bring green solutions. And the second opportunity lies in this space is, once we have enough green investment opportunity, and the banks have products and services to focus in the green space, we got to find out technology solution which will help banks to monitor the green commitment that the firms are making as they're tapping into the green finance. And to do that, there's a need for a lot of data-driven technology which will facilitate this monitoring. And today, as you know, there's a lot of lack of transparency how the ESG data is acquired. The data quality is quite different. It's very hard to trust. Some are real, some are unreal, some are not real time. So there's a need for a lot of technology focus and technology investment, so that we can monitor this data, this green commitment for any firms accessing green finance. And is there an opportunity for fintechs to build APIs where they can then provide the ESG based data based on certain taxonomies and standards, and that data can be consumed by the banks to monitor the commitment the firms made while they're tapped into green finance. And finally is, how do we measure impact? And we find that FIs struggle with measuring the real impact of green finance. While there are evolving models, there are some solutions out there, still at a very early stage. So there needs to be some discussion around what kind of infrastructure, whether public or private, we must have in place so that FIs can measure the impact of their investment either through a mechanism of using digital identity or IoT infrastructures or some kind of a smart city, holistic, comprehensive programs. And so we are looking at a broad range of opportunity where there's a green finance, there's a measurement of the commitment for anybody tapping into green finance can be measured. And then how do we take all the data and process and pass it back to the FIs so they can measure the impact they're making by the shift in their strategy as they look at green finance as the next decade focus area for the financial sector. So all this required a lot of technology, a lot of machine learning, AI-based technology. In fact, I would say, I'll argue the space where is getting more exciting in the technology space for green is the DLT space, because and the digital ledger technology comes with that unique ability to build strong data provenance and also creates that sharing of data ledgers so that as we think about green finance being deployed on asset which is distributed across many geographical locations, having a DLT-based architecture on which an AI or machine learning is running and having data to look at which is trusted can become a truly an end-state comprehensive technology framework as we think about green fintech. So I'm quite hopeful that a large part of fintech ecosystem and fintech community will start pivoting a lot of their solutions to adopt the green requirement. And we are already seeing examples in the space of wealth management. There's already fintechs out there who are able to compute how the investments individuals are making and what are the green impact such investment can be translated in a way they feel good about it. So exciting time. We truly believe technology will become a critical enabler as we shift to the green finance in months to come.
Sopnendu, thank you very much. I must say, this is the first Zoom I've had for a long time where we didn't have somebody with a virtual background to make us all feel good, but you're actually sitting on the balcony in the real environment. You make me very jealous. But coming back to the substance, I think you've set out a really nice framework here, which is, the importance of risk capital for kind of, going into R&D and new possibilities. But to do that, we need a good data set, good quality data set. We need AI to analyze that data set. We need DLT and other applications to distribute that information in a way that, it can be used and effectively applied. And then therefore the impact can be measured, which then drives again risk management and risk capital financing. I feel it's kind of a virtuous circle. A very nice framework. I think we will unpack these different layers in a moment. But Michael, I would like to pass over to you, as I know that both AFME and GFMA have really been at the forefront in the wholesale markets and thinking through what this risk management framework should look like and what's really required to allow financial institutions to take ESG criteria into consideration in their risk management.
Well, thank you, Nicholas, and good morning, everybody, and good afternoon, Sopnendu. And you gave a brilliant framework because the scale of what we're dealing with, and this is aside from the global pandemic, the global recession, the climate change urgency is really being brought to the fore. And I think it's been given a huge boost by the election of a new president in the States. Joe Biden has certainly almost unlocked the US banks to be able to actively participate and think about these challenges, unlock US industry. The scale of the challenge is immense. If we're going to collectively meet this net zero target by 2050, the latest GFMA report that is available, Nicholas, to all of your participants today has estimated $150 trillion of spend, and 3 to 5 trillion a year. We need to allocate that and see that that is appropriately spent around the world. And the report estimates 66% of that needs to go into Asia. So Sopnendu is right at the heart of this with the Singapore green fintech agenda. And it's compelling to hear. And all of the tools that he laid out are being considered and trialed in the banks. And they're trialed in two parts of the banks. Clearly, the banks as providers of finance, whether it's on balance sheet, the loan book, or whether it's all the arrangement that is done through the origination, underwriting, and syndication of debt that ends up getting held by investors, or green equity that gets end up held up by investors. All of that needs to be managed, and maybe the important thing to say is that a global framework that helps to provide that standardization and common language is beginning to emerge. And it's not surprising that our central banks around the world are really taking the lead here on the risk management subject. And the collective of central banks who are forming the network for greening the financial system are sharing their methodology. They're beginning to think about how to roll out stress tests. And perhaps we can get into that. But foundational to all of that is obviously exactly what Sopnendu is talking about, the quality of the data and the measurability of the data, but an agreement as to what data we're trying to collect, how we're going to share it. And Europe has certainly, again, taken a lead here, and the European data space, I think, offers significant cross-sector opportunities and standardization opportunities. Let me pause there, Nick.
Thank you very much indeed, Michael, because I think great minds think alike, because I think as a first step, we should look at data a little bit more. And I think you put this very nicely. I think there are two steps to it. One is what data. So this brings us in the European context into discussions on taxonomies and the type of data that we need to collect. I know Singapore joined the international platform just recently, and there is these efforts to come up with a base taxonomy. But I think one question is to you, Sopnendu, what data, what is the type of data that we're looking for? Because there's so much sensor technology, non-personal data, there's all kinds of stuff out there, and we have to decide what we're actually collecting and why. And secondly, I think this question about standardization, usability, and transparency, so that everybody has access to that data and can use that data for their analysis. How are you looking at those two questions from a Singapore perspective?
Look, Nicholas, I think one of the elephant in the room is that the space in green, transparencies can become its own enemy as we think about green finance, because the economic trade-off you have to make in the transient process to switch to green may not be politically or economically suitable for many of these targets market you're looking at, especially in Asia, with the social because the social challenges and economic challenges to shifting, which means the desired ideal end state ESG data you would like to have would be very challenging because the data in the current form can cause more I would say doomsday scenario and rather than it can help the cause. So there are multiple layers where we are seeing challenges and opportunity also same time, but that needs a transitory thinking. First thing is to establish a taxonomy, which I think Europe has done a remarkable work. MAS is also participating in many of the discussion and building data set to the green standard, to sustainable standards. But the real challenge comes in reporting and the ability to share the data and the infringement to many layer of, I'll not say privacy because privacy is less issue here, more about the cost of shifting the to green agenda may not be always economically feasible now, and that means that there's a chicken egg situation, that how do you extend incentive for green finance as and a precondition on a ESG data which is completely transparent and completely usable. I think there'll be need for a intermediate steps as you build better technology, as you build better green solution, which can make the process of shift affordable, then you will see a better data collection, better data set. But that needs a baby step process to get there. And let me come back to the first, because we spoke of, when I opened my intervention, we talked about measurement and monitoring. But we have to come back to the first step, which is mobilizing capital, so that when we think about green finance and we expect that particular asset to comply to green standard, we also must help that firm to look for solutions which will be enabling that particular sector to get to the green commitment data set. So it has to come together. Then there's a possibility and a feasibility to get the real green data you're looking for. But I'll be afraid to say that at this point we are far away from that step. We are still at the early stage of defining, bring the definition correct, and I'm sure many jurisdictions will push back and argue and decide before they agree on a common standard. Primarily not because they feel that it's not right. Primarily they feel that the transition risk and the transition cost is too high.
Thank you. Before I come to Michael, maybe one quick follow-up question. In Europe, there's this thinking about, as Michael said, data spaces. The way I described them after a panel earlier in the week is that effectively people are allowed to exchange information in a free space, that it's not anti-competitive and so on and so forth. And the level of exchange of information depends a bit on who you are and what the data is. There might be free data exchange, there might be data exchange in the same space based on contractual arrangements, and there might be more sensitive data exchanges, different layers in the same data space. How do you see this around the reporting and around collection of data? Have you thought about this in Singapore? And not just in Singapore, but I think in your case also a bit for the region. How do you kind of collate the data, as you say, and make it affordable?
Well, that's a challenge. That's a work in progress. But I'll give you a provocative option here. And I don't know whether you are tracking or you're looking at. There are examples already where we call as public data set, which means citizens' data. There's an example. After the Fukushima disaster in Japan, there was a citizen data movement in Japan where they created IoT devices, and it was a mobile IoT devices which people carried with them, and that device captures a whole set of environmental data, and that data was sent to cloud, and people can independently look at data set collected by anyone of us. I stay in a place like this, I have a little device, it is capturing environmental data and transmitting to the cloud. Now around me there could be asset which is influencing this data set. So this becomes a citizen-driven data set which is publicly available with no bias and no manipulation, and it is open data set. So there's this concept of citizen data set which can become an interesting play in this space of green data collection. But that has its own limitation. There are certain data set you can do, but you cannot get data set within the asset which is more deeper. You can give a general broad sense of independent data collection. So our step is that I think we should start with pilot initiative. I think the best way to start, which we will, so I hope we'll be announcing shortly through the year, where we will have pilots with a target asset, which is perhaps sitting in multiple geography, where a certain finance was made and a certain KPIs were predetermined, and then we can put solutions to then capture this data set and monitor how feasible is to capture data, especially most of the data will be cross-border. It's hard to believe that when you're capturing such data, there's a huge, it will be concentrated in one domestic space. It will tend to be multiple jurisdictions pulling data from different jurisdictions to measure the impact. So it's still at a pilot stage. We don't have a definite answer to that, but we hope that this year we'll get to something to discuss towards the end of the year.
Thank you very much indeed. I think when you talked about the Japanese model, I thought of kind of Europe has fairly strict rules on air pollution, which are never met by, I think, most urban areas anywhere, at least not my local town in northern Germany. So if we all had these devices, I think it would put incredible pressure on public authorities, and we might get there. Michael, I think maybe over to you. I think, your views a bit on data as well. I think James, your colleague already in the panel on this, discussed the need for interlinkage of data sets, not just within regions, but kind of internationally, which listening to Sopnendu is maybe a bit optimistic in the short term, but it'd be interesting to hear your views on that. And then I think moving to risk management, Sopnendu also just mentioned quite rightly that the whole issue is around transition, because transition is, I think, closely linked to risk management. We have to start with the high-risk activities first and then transform over time. Maybe your thoughts on these 2 points.
Yeah. So I think responding to Sopnendu's comments, I think it's reducing duplication. So every citizen collects data via their iPhone. We all have our sensors. We might be wearing more sensing materials that can collect and deliver data. But reducing the duplication of data collection and creating that standardization, making sure that it's machine readable, make sure it's readily transferable by appropriate API development is going to be essential, because we're at the very early stage of climate and environmental risk scenario analysis. Stress testing has not yet started. The Bank of England is planning to start the stress testing of UK banks later this year. And these are, exactly as Sopnendu describes, proofs of concept that everyone is going to be learning from. And yes, there are the transition risks, and clearly the world wants it smooth as opposed to abrupt, and everyone has their definition of what smooth looks like from their own perspective, and so that's where the friction is going to be. And if I try to impose smooth on you, that may not seem fair or just. So we'll get into talking about the fairness of it. And then, of course, there are the climate physical risks as well, and those are going to be stress tests. We haven't even begun to think about other environmental risks yet in any serious manner, and we know we have to accelerate towards that as well. The good news, as I said earlier, is that there is a framework, and there is real collaboration between the central banks, and the central banks as thought leaders, the central banks as supervisors and regulators, and they're sharing their data, but that data needs to be collected. And it's not just the banks, it's obviously the investor community as well, needs to assure its underlying sponsors, the individual citizen, that it is truly able to measure and capture and invest in the types of assets that the citizen is going to be demanding. And so that comes back to taxonomy of the underlying data. So we can't emphasize enough standardization, open access, and making it machine readable, because if every citizen is going to be collecting data via their device, it's an intensely valuable resource.
Thank you, Michael. Yes, please go in immediately.
That's a quick one. I think one of the, because you had the risk management questions, so I thought of not missing this point here, that I think generally speaking, which is actually factually true, green projects are riskier project from a credit perspective. It's just damn expensive. It is still on an early stage process. I think the incentive which green finance, banks, regulators, policymakers are going to inject into the process will create a bit of a sustainable green projects, and that will incentivize then investors to look at the project with a different lens. And of course, with the better use of, as Michael's talked about AI and machine learning, it can help to predict better that the transitionary risk is something can be covered on a long-term basis, and then the profitability can be better understood. If we can get all these pieces together through model testing, through stress testing, I think there is a hope down the way. But I would be not overly optimistic based on the progress we have till date that we are ready for that. I think it has to go through its own cycle of test, POCs, pilots before you can talk about uh, something we can all become confident about, a proper risk management framework to get to a real state of green transition.
Thank you very much. And I think that brings me to one follow-up question, Sopnendu, which we discussed as well, which is on financial inclusion. Because first of all, I think I agree with you. We will get to the predictability and a better management of the risks, and the profitability relate to that. Big challenge at the moment is just the lack of data sets, and therefore it's so hard to have this forward-looking view. It's why we in Europe had this discussion about green supporting factors in the prudential framework, but it's very hard to pinpoint them. But how do you see this for SMEs, for this, the more we go down, it's fine for big corporates. It's a bit of a pain, but it's doable maybe. But how do we roll this out?
Well, look, I think this is a non-negotiable discussion, I'll say, because SMEs are 80% of GDP in many, especially Asian market. I mean, they're 80% of the growth. They're 80% of the employment. They are the backbone of every country. And if you really have to do a green shift, they have to shift also. When I said it is not that easy, because as we all discussed, that it is costly, it is very intensive. Today the SMEs may not have all the processes. The electric consumption, their water consumption may not be the most efficient. The tools they are using may not be the most modern, because this all require a lot of capital injection. They need a lot of access to capital so they can make a fundamental shift in their own infrastructure. I think here the play is in multiple. There has to be a public infrastructure, public play, which allows that, especially on SMEs, when it comes to data collection, measurement, monitoring, incentive, certification, it has to be a public utility, because it's just not possible without that scale of because SMEs on its own will not able to afford that. So you need an aggregated infrastructure to manage the scale and the cost structure. Second, I would say that while SMEs seems to be a large number in terms of executing and implementing, but they're also an interesting use case, because with the advances in the IoT devices, low Earth or orbit scanning, better API integration, it is becoming far more easier to deploy tools at the SME endpoint. I use the word called endpoint computing, where you can put tools at the endpoint of the SMEs where they operate and help them to develop green awareness. For example, can the SME financing be can there be an incentive for SMEs who are doing a better electric consumption, energy consumption, to be able to transfer their credit so that they can have a better financing? There's a whole set of possibilities, but to do that, we need endpoint computing, endpoint measurement. And a lot of public utility energy companies are start thinking about providing APIs even to the small businesses, who can then capture the data and use it to have access to green finance. So I think that whole green loan for SMEs, green project for a large aggregated sector for SMEs can be an interesting play. And who knows, it may be the green SMEs who will be the first real success before the large corporates.
Maybe one very last short closing question. What instruments do you see on the investment side as particularly successful in stimulating these multi-trillion investments that are needed? Europe is spending a lot of time discussing green bonds at the moment, but it's yet another debt instrument. Mikey, you talked about green equity. You just now, Sopnendu spoke about, lending, green lending. Where do you see, and the risk capital, more importantly, at the beginning of your intervention, where should we move to kind of stimulate as much funding in this space as possible? Just short comments. Maybe Michael, with you first.
Okay, so everything we've discussed is a piece of the puzzle. I don't think we discussed carbon credits and really developing a voluntary carbon credit trading market. Every citizen needs to know the price of carbon, and ideally it's going to be a standardized price of carbon, but getting to that will take a while. But they need to know their price of carbon, And there need to be this concept of green dividends for the citizen. And that citizen is often the employee of the small and medium-sized business. We have, 22 million of them throughout Europe, maybe employing 4 million people each. 88 million citizens being able to receive some sort of incentive within their small and medium-sized enterprise, I think will be a phenomenal green dividend. But somewhere in the middle of all of this, we've got to get the carbon credit trading market really liquid and united.
Thank you. I couldn't agree more. Sopnendu, the
Very
last
quick.
word to you.
Very quick one. I think we should not get, while green bonds and other complex instruments are exciting, it attracts a lot of academic focus. My simple submission is that if we can focus on simple green loans and create an incentive structure for small businesses to change their behavior of energy consumption, that will be a great start and a great financial instrument to begin with.
Thank you. I think that's very, very interesting. Thanks to both of you. Thanks for joining us this afternoon, Sopnendu, and reminding us that there's a world outside our little four walls. And Michael, it's always a great pleasure. Thank you for being with us.